Hello, everyone. I'm John Furrier at theCUBE Pod, episode 108. Yes, it's 108. I said that last week. Last week was 107. I said 108. Dave, salute to you.
John, how you doing?
I know your breaking analysis just done.
You're looking very
Here
red.
in the New York Stock Exchange. I don't know why I'm red today. Maybe it's the lights. It's been hot in New York. We had the big thunderstorm, flash floods, subway gets floods. But I'm here in the exchange. Big day yesterday, IPO from Figma.
Yeah.
Colossal IPO, big deal. It's a carnival outside. It was a huge zoo inside the exchange, packed with Figma people. Obviously, Figma IPO has been skyrocketing. I mean, it priced at 33 with the bankers, opened at 85, closed over 110 yesterday. Today, it closed at 122 now, and after hours, it's looking at 125 a share. Pre-morning, though, today's opening bell, it surged to $144 a share, dipped down to 112 at the opening, shot back up to 127, bounced around to close at 122, and now after hours for 125. Massive returns, Dave, on this. And this brings up, the conversation is how IPOs, the demand for IPOs, first of all, hot. The miscalculation on the economics for the demand put a lot of money in people's pockets, the bankers, the VCs, people who bought at the low price, sandbagged out big time. I'm going to say sandbag in a complimentary way. I wrote a post on LinkedIn about it, just from the venture capital side of it. The numbers are off the charts. But also there's a sub-story, and this is a classic Silicon Valley startup. You got John Lilly at Greylock, great investor, very pro product, very pro founder, well known being a shepherd in the business. He shepherded the founder, aligned with the vision. During the vulnerable times, kind of kept it going, could have gone off the rails. Figma was started in 2012 and really didn't hit escape velocity until well into product market fit, before the pandemic. So we saw that move. And also Mamoon Hamid, who runs Kleiner Perkins, I knew him when he was at US VP. He a great smart investor. He's friends with Lilly. They were on a board together. And because of their friendship and the teamwork, he got a look at the B round, saw the Lilly's in. It's a no-brainer to what he's going to put in. And so that's kind of how it worked. You got good investor teamwork on the Valley going on, two good firms, Kleiner Perkins and Greylock, tier one. Sequoia came in, obviously Index did the early round as well. So classic execution on the VC side. So I got hats off to the Silicon Valley VCs on this one. It's like old school, the right way to do a venture. Let the founders do it right during the vulnerable period. You don't want to judge them. Let them incubate. Let the petri dish experiment go. Good founders, good design chops. They target the community. They do all the right things on their own timetable with the market. Pops. Now let's look at the numbers. Index Ventures, $400 million fund returns $7 billion. That's a 17.5x multiple. Greylock fund size of $600 million. Figma returns $6.5 billion. That's a 10.8x. Kleiner Perkins, $700 million fund that Mamoon runs, returned $5.7 billion. That's an 8.1x. And of course, Sequoia comes in, Johnny come lately. They pile in, little Silicon Valley teamwork there, jump on the bandwagon. Their fund size is $2.5 billion. The return from Figma, $3.5 billion, 1.4x. They're returning their funds, Dave, in one deal. This is the grand slam of all time in the venture class community. So from a money-making standpoint, on the venture side, home run, grand slam, done the right way. Everyone made money. Smashing success at the IPO. NYSE had a whole brand takeover for Figma. Very much it was the Figma exchange for a day. They're all wearing the smocks, for trading smock with the Figma logo. Total IPO madness in a good way.
Well,
but the bottom line is, the VCs made a bunch of bank. Now, Bill Gurley posted that, hey, this is not how IPO should be done. They underestimated the demand. So now the pissing contest happens. But just look at the returns, Dave, on the Grand Slam. I mean, it only takes one. Figma was the one. Index, Greylock, Kleiner, Sequoia, return the entire fund. My phone's been ringing off the hook. from the friends in Silicon Valley saying, hey, I'm in that deal. I invested in that fund. They're all raking it in. So, the money-making power of venture nailed it. So, is it a feature or a bug? Now, Gurley's like, it's a bug. The system's rigged. Now, he's on the VC side too. He just wasn't in the deal. So, really kind of nuanced point, but very strong entrepreneurial piece. The employees that were here from Figma, they were unbelievable. I was standing next to one on the balcony. Like, you think it's going to go to 50? It's definitely going to be over 50. They're like, oh my God, that'd be amazing. Can you imagine if it goes to 100? I'm like, oh yeah, it could hit over 100. And I'm like, yeah, we'll see. It hit 110 plus. Now it's 125 after hours. So newly minted billionaires, newly minted hundreds of millions of dollars of value for people. The employees all raked it in. The VCs raked it in. Now the retail side's there. And my preamble to the IPO was Canva's even bigger. So we'll see if Canva goes out. Canva's the #2 app behind ChatGPT. These two software apps represent the new normal. So huge day, a lot to unpack there, but that to me is the core story. Money making gone right, done right, venture built right, money making done right, IPO certainly done right at the NYSE. On one side, Bill Gurley's the other. So overall, great story, great day. It was very festive, carnival-like environment. And this is the new stock market. It's carnival time.
Well, the other backdrop here is that you remember Adobe tried to buy Figma, and Figma agreed to the acquisition for $20 billion. Adobe first tried to go after him in 2020, and then I think it was 2022 they agreed, but it wasn't until 2023 in December where they terminated the deal because I think it was the UK competition committee and it was somebody in EU. But I mean, 20 billion now it's worth nearly 60 billion. And so it reminds me of ARM, where ARM, NVIDIA had agreed to buy ARM for like 45 billion. You look at the value of ARM today, it's 100 billion plus. So I mean, that is astounding to me. I think the stock opened at what, 30? And then it was
priced at 33 at the bankers, opened at 85 right out of the gate.
Opened at 85. It was priced at 30. So, and that's where Gurley was complaining that they left a lot of money on the table. I talked to Frank Slootman about this. You remember when Snowflake went public, the friends and family price was 120. I think it opened at 180. I think it closed that day at like high twos or even 300. And I asked Slootman about it. And he's like, look, this thing was de-risked and everybody made money, kind of enthusiastic like you. Gurley, like you said, takes the other side of the trade there, saying, oh, maybe he was just sour grapes because he wasn't in the deal, or I don't know. But I think his point is, hey, the bankers pigged out, and they could have priced it more balanced, so that the retail investors got a better deal. But hey,
it's your expression, the two-armed lawyer. On one hand, you got this, on the other hand, you got that. I mean, you can slice it from both sides, right? So to me, look at. Gurley's not wrong either. He's like, hey, you know what? If they under forecasted the demand for this thing, they priced it wrong. Now, that also doesn't favor the haves on the have-nots. So you got the world of the have and have-nots view. Okay, the rich people who have access to the Morgan Stanley bank accounts, has a ton of capital, they get a bump up instantly because the bankers have set the price for the spread. And they probably knew the demand. And they knew the roadshow was kicking ass. We heard from inside sources that the roadshow was kicking ass. Clearly they came in 33s on the high end of the forecast. Come on. So they knew that they were doing. Okay, that's not a bad thing. I don't think. Personally, I think it's a good thing. You got some dough and you got access. Yeah, take it. And you keep it, you sell it, you make a bump. Put that in your pocket. But the retail investor side also is interesting. Now, Figma has to be a durable company. Now, I was watching Andrew Sorkin on CNBC this morning commenting about his interview he did right here on the balcony next to our studio with Dylan. And he said he has a compensation package, big time, to maintain the stock price through a period of time.
Yeah, Elon-like.
Period of time. Very Elon-like. And so that's incentive. Now it's big incentive.
But it's different. My understanding is it's different because he's got to hold it for, he's got, different milestones, but some of them he's got to hold it for like 60 days. Others he's got to hold for years. So that's maybe
and the employees are all locked. They're all locked up, and they kind of said that to me off the record. But I mean, the bottom line is that, lock up or not, you don't want this thing. Gurley's right if it pops and then screws investors, but the thing is a durable company and has legs, and the CEO at the helm, who's proven himself to be a great young CEO, yeah, Dan, give him the wheel, the ship, let him navigate. So it's on him. We'll see, and that's what company leaders do. So I think that's fine with me. I have no problem with that. I think Gurley is pointing out a bigger issue, which is what is the future of these exchanges? Why should they go public this way? Why can't we get everyone to be equal? It's a good
Or
question.
do direct listings, right?
Or
That's
do
the
direct.
other. But
But
I
they
mean,
raised, but they raised a lot of money, and a lot of the employees and venture guys sold. That's where they got their returns from. So, on one hand, yeah, they take a margin spread, they sell at that price, they're locking their side in. So they
well, that's
lock
what
in their
Sloopin's
returns.
point was, is that they de-risked it for a lot of people. They're like, hey, they
Yeah.
wanted to take money off the table. You just articulated how much the original investors made. I don't think they're unhappy. I don't think
I
they're
mean, look, I
pissed.
mean, let's put it in perspective. A 400, a 600, a 700, or $2.5 billion fund returns in one deal. That means it's house money from day one. If you look at Sequoia, no, Sequoia has a bigger fund, so they had only had a 1.4x, but they had a $2.5 billion fund to invest in entrepreneurship. One deal pays it out, and the other ones were like 17x multiples on the fund size. That's insane. That is a grand slam, walk-off home run World Series moment for a VC. That is like the creme de la creme moment. Now, Figma fundamentals, some would say, is not that impressive compared to the home run on the VC side, but it's a great company. I'm not saying they're a bad company. I'm just saying they don't have zillion users like Meta. They're not there yet. We'll see what they do. Canva, like I said, blows away Figma from a metric standpoint. They've been profitable for over 8 years, according to sources. They have more active users daily than Figma, and they're the number 2 used app and number 2 downloaded app in the Apple in the Apple store. So they're already number 2 behind ChatGPT. So Canva is going to be a monster. I said Figma is going to be a monster. Canva will be a super monster. So I think this is a sign of the times. If Figma is going to pop like this, if the market conditions don't change.
It underscores how much the demand is for quality IPOs. And, we've been talking about this. We said, I think we called it correctly, the first half was going to be tepid for IPOs, and they're going to start to hit in the second half. But now's the time. I mean, there's a window there. I would think people are going to try to rush to get out. It's really interesting to see if a company like, we talked about this last week, if Sneak goes, maybe they're not ready, or maybe a Veeam, and who they raised some money, Insight sold, a couple billion. And so, when the market's hot, you got to strike. And
I mean, if you look at the money making side of the equation, this is how the business works. Okay, and now there's a lot of subplots. I pointed out the teamwork in Silicon Valley. There's also the subplot around the New York Stock Exchange. They essentially had Figma had to do a takeover. They had media all over the place. We were reporting from outside the venue and all on the shelf here, on the balcony here. But most of the thing, all the top media outlets came in, so they got a lot of media buzz. So hats off to the NYSE. They turned it into a celebration, which is a great place to do it. And so that's the future of the exchange. That's what they're going to look to do. Your subplot around the Adobe acquisition is telling, because Figma was a success at 20 billion inside the VC community. Hey, we're selling for 20 billion, okay, which is a great deal. Adobe had that vision to grab Figma. Why not jump on Figma before Figma cannibalizes Adobe? That's a smart M&A move on Adobe's part. But that deal goes sideways not because Adobe. Everyone's like, Adobe blew it. Adobe didn't blow it. They had the deal. They had to pay a breakup fee of $1 billion. That's just to pay for all the crap that they had to deal with, and the walkaway fee for either the distraction or the things that go into walking away from a deal. So Figma was looking good with Adobe. It was the regulators that killed that deal, and that's bad for Adobe in this case. Adobe is the loser on this one because, one, they lost out on a great deal that's clearly more valuable than they paid. So what's the upside potential for Adobe? And two, they now have a competitor that's going to have a flush full of capital and equity to do acquisitions. So, I mean, if you're Figma, you're going to buy an AI company. You're going to go into the arena with Meta and try to buy some AI companies. These young kids starting companies between 18 and 25 years old. All the hot companies coming out are going to be young founders, and there's going to be a huge M&A boom in AI because the market, the buyers, Figma, Meta, they're all lining up. It's an arms race on the talent. So, I just read a report this morning that Meta had a target that they were trying to bring on an individual, turned down $1 billion, okay, in a multi-year period. Athletes aren't getting paid this, right? It's like,
No,
it's like,
no.
so, I have never seen this kind of tech athlete moment, in our coverage than I've ever before. So I think this Figma deal is going to moment in time. It's an IPO version of the ChatGPT moment if this becomes kind of the standard. And, do I think Figma's worth like 80 billion or 60 billion, whatever the numbers come out to be? It's significantly higher than, it's 3 to 4x higher than 20 billion. Right. And it'll be that number. Does it sustain it? And is it worth it?
Well, and
Those
it's
are the
also going to
questions.
be interesting to see what happens. I generally don't like when people buy, at the IPO, because I think you get a lot of froth. And usually you get better entry points. You certainly saw this with Facebook when it went public, took off, and then there were much better entry points. You saw it with Alibaba. You definitely saw it with Snowflake. You could have picked up Snowflake,
Yeah.
several months ago for 118, I think, and
Yeah.
the thing was priced at 120 for friends and family. Now it's back up again. But so I generally, now there are exceptions,
Yeah,
and so it's going to be
Apple,
interesting to see.
Nvidia. I mean, this is a tough call for an investor. I mean, I like your entry point strategy. I think that's the right one. Most statistically, they dip on after a few quarters of the
And then
stock
you
fall,
jump in,
and then
yeah.
you
But when
jump
people
in,
are all chickening out and
and
selling,
then you gotta see the dips. But here's what people make the mistake. Oh man, the price is pushing all-time highs. Companies that go escape velocity and go vertical on the slope, they're always hitting new highs. So if you said that about
yep.
Nvidia 3 years ago, you jumped in there. So it doesn't have to be the dip. Okay, that's my point. Sometimes you look at the dip, and that's the question for the investors: is this thing dippable? Will it dip or not? Now, I'm thinking it will dip because I think Canva, if Canva went public next month, okay, they would crush it here, right? They would crush their IPO. And then when you start seeing comparable metrics, that's when the market's efficient. I think, this is Darwinism here at Wall Street, capitalism, they say, but, the scuttlebutt and the those traders and the folks who are Wall Street, it's Darwinism. So if you get a comparable out there like a Canva and Figma, you know, you don't know what's going to happen. And if they miss a quarter, product led growth doesn't kick in on this AI wave, you don't know. Anything could happen. Anything's possible. Now, I don't think it's that possible because they got a great team. The loyalty of the employees. It feels a lot like a Netscape moment in the sense of very bubbly from a pop standpoint, 250% on the IPO. But in talking to the employees here, it's clear that this is not like, hey, we made it, let's cash out. They just went through hell with this $20 billion acquisition with Adobe that was sideways for how long? I mean, over a
It
year, two
was,
years.
well, it actually,
What was the
it was
duration on that?
really,
You
it really
check
was
that
from
out.
2020 to 2023. 2020 is when Adobe first made attempts to acquire Figma because they had to fill a gap, right? Figma was eating Adobe's lunch. And then so it was a great I mean, in retrospect, it would have been an awesome acquisition for
They were
Adobe.
right. They were right
But
on the M&A side. All
and
the
so
calculations prove it was worth more.
and Adobe has had to, organically build stuff, which I think they've done an okay job filling the gap there. But Figma would have been a home run for them at 20 billion.
Can you imagine being an employee for that 3 year period, 2.5 year period of constant, like, what are we going to do? Now the shackles are off. I mean, if you're a Figma employee, you're rich, you've made it, your hard work has paid off, the mission, back to the mission. And if they can keep that founder led focus with Dylan at the helm, they got a great board. John Lilly's awesome. I was chatting with him on last night on Twitter, on X. Mamoon's a great investor, pedigree founders. So we'll see what happens with the board. Looks like they're making up a great board. Got big names coming on there that we know in the enterprise that have been on the show. So, I'm not down on Figma. I love the IPO action here, and I think this is going to be a tell sign. I think we're going to see the window open up unless there's some sort of external force politically or some geopolitical force. This market looks like Q1, Q2 of next year will be on fire with listings, tech IPOs. There's a thirst. And I think the
Well,
AI injection has kind of frothed everything up too. So hype
yeah,
cycle combined with new companies, combined with results, and
it
man,
it it also shows
it's
that
lining up.
it also shows that sometimes these executives undervalue things. Look at again, look at ARM. I mean, ARM. I think SoftBank bought ARM for like 32 billion, and Nvidia tried to buy him for 40 or 45 billion, and they're worth 104. They're worth $100 billion more than what Nvidia was going to pay for them, right?
Yeah.
And so, and you see this Adobe deal. So, a lot of times for whatever reason, yeah, it looks like a good deal. The board says,
Yeah.
yeah, let's cash out. Yeah, that's too risky, and then all of a sudden these waves hit. We saw it with .com. I mean,
Yeah.
a lot of billionaires were minted, and we're seeing that. We're going to see more and more. This is just the beginning of the cycle. It's going to be interesting to see how. I mean, at some point, we know it's going to blow up. Maybe. Yeah, well, but that's a topic for another day. But George and I were with Breaking Analysis this week are looking at kind of enterprise AI and what's missing. Nobody's talking about the data. Everybody's talking about the agents and all the boxes, but nobody's talking about how, the importance of data. They talk about the importance of data, but not in the context of enterprise AI and AGI. LLMs are going to run out of data to train on. It's like It's like LLM, communism. Everybody's going to have the same sort of democratized insights. And it's that Jamie Dimon is Sam Altman's biggest competitor premise, which is where enterprises have to apply or will apply their own proprietary data, but it's all about the data. And
Yeah.
nobody's really thought about that. They talk about the agents and the agent control frameworks and agent management and the agent builders and IDEs to build agents. And you think about coding and how effective agents are with coding. And the reason is because you can sort of you understand it's Boolean. Like you
Yeah.
understand
Yeah.
what a compiler does and what the outcome is supposed to look like. That's why LLMs are so good at math. Well, why aren't they generalizable into legal or hospitality or retail or all these other industries, medical? It's because of the data, and and the data is not as predictable. The outcomes aren't as predictable. So unless we see that happen, this whole thing could blow up. In other words,
Yeah.
right now it's being powered, as you know, by the CapEx. If you just back a math on the earnings calls, we're now over $350 billion in CapEx on a run rate basis for Meta, Amazon, Google, and Microsoft. And that's where all the action is. And so it's not in the enterprise AI yet. There's still a lot of room
Yeah.
to show ROI there. And if at some point we don't start seeing that, this thing could blow up.
I just posted on LinkedIn a paper I read in a post from Dennis O. I don't know his last name, but I'll follow him. He said, I wrote, LLMs are hitting a wall. And he posted a post around this data. People from the University College in London and the Italian Institute of Technology just put a real poke in the math. They formalized a model using scaling laws, entropy bounds, and statistical mechanics. They show that LLMs cannot escape the built-in wall or limit. It's not something temporary. It's not due to the lack of bad data or insufficient tuning. It's structural. And he's saying that transformers, the famous transformer papers that set this LLM craze in motion, is great at predicting the next token on statistical patterns, but it's not ideal for intelligence and reasoning. So they kind of come in and say there's a divergence between LLMs data and other factors that they think that there's a diminishing return of LLMs and that it's not reliable to complex semantic signaling into smooth Gaussian latent and then get the full structure with decoding. So this is basically saying that LLMs, they fizzle out, okay? There's a diminishing return. And so that's where the hallucination. So I think there's real intellectual capital going on saying, okay, thanks for the transformers, thanks for the LLMs, but that's not the end game. It's a nice start. And to you and George's point in your breaking analysis is enterprise AI will not tolerate lostness in anything, whether it's hallucinations or diminishing returns of real intelligence. So I think you'll see enterprise adoption stay within the RAG use case, retrieval augmentation generation, and other productivity low-hanging fruit. but stuff that's going to get into production that's going to drive the real productivity is great. I mean, I'm using some tools right now that literally save me so much time, but we're not a large scale enterprise. We don't work at JP Morgan Chase. We don't work at Citi. We don't work at these big banks. We don't work in regulated industries where there's life sciences and intellectual property. So I think the AI game is going to still be a simmer before it gets hot. I think it's still hyped up with agents, but data, the data layer, some of these tools, some of the models, they just got to be baked out a little bit further. So I think that's going to be just evolution. I don't think there's any vendor problem. I think it's more of a technology application.
But the locus of value could shift. I mean, these LLM vendors could be the next, Lycos and Alta Vista. We'll see. But I'll give you some data that George, shared with me and that we're going to publish this week. Training costs, 35 million to train GPT-3, 400 million to train GPT-4, 2 billion to train GPT-5. That's the estimate. The estimate is 10 billion for GPT-6, and you extrapolate that, could be 50 billion for GPT-7 just to keep bending the curve so that you're not hitting a wall. And so, and you're going to run into situations where you're running out of data to train on. So you're going to use synthetic data. And that's where proprietary data that's inside of JPMC and other enterprises is so valuable. And so, and you look at the cost of these things. And the other thing is, George shared data with me using the competitive advantage gap and the competitive advantage period, and it's shrinking. I mean, what stands out is, you got GPT 4.0 takes the lead, and within weeks, DeepSeek or Gemini closes that gap, and there's no switching cost from, there's a few lines of Python code. And so the cap shortens with every release. In other words, you can spend $1 billion on compute and data, and you could only have a 6-week pricing umbrella. You think about the pharmaceutical industry. You have a 10 to 12 year advantage, a patent advantage. You could argue it's 20, but it probably takes 10 years to get through the trials. But you literally have a decade plus of patent protection. And you're talking here about not, weeks before somebody catches up and reduces your advantage to zero. The LLM business is brutal. And so that's where packaging agents on top is key. I mean, LLMs, these models in and of themselves, are just incredibly, cost prohibitive to build. When you can add agents in, that's where it starts to get exciting.
And if you connect the dots on the paper I just mentioned, that kind of also connects to your point, which is, it's not just that LLMs has a diminishing return. It's that as people invest in LLMs for the reasons you pointed out, and again with the short shelf life of advantage, they have to figure out ways to go to the next level, right? So that's agent bolt-on, workflow process, but new technologies beyond transformers. So I think that's going to be good for the industry because more energy is going to go into building better stuff. So we'll watch that technology. Now, it may or may not be good news for the big hyperscalers. I mean, Dave, if you look at the Q2 results, this week was a huge week of earnings. I mean, let's get into the earnings. I think
before we do, I'll just make a point. One, and it ties into the earnings. I mean, Apple, you saw Apple hit some records. I actually thought they had a really, really good quarter. My point is, as it pertains to LLMs, Apple may very well have the right strategy here. Let the others, deal with the bloodbath, and we'll just, pick up the pieces and partner. But the earnings.
I think we talked about that a few pods ago. It was right on. I think it's when they have sitting on a pile of cash, just wait for the bankruptcy courts, or basically people being desperate. And because they got the distribution. Let's face it, Apple's numbers are great. We'll talk about those results. But let's get, I want to get into the earnings.
So you had that, you had M&A with Palo Alto and CyberArk. I want to talk about that. But let's get into the earnings.
Let's get because it's a big chunk of content, right? You got the 4 giants, Microsoft, Apple, Alphabet, and Amazon all reported. I mean, all demonstrated good growth, profitability, driven by cloud AI and diverse services offerings. Microsoft and Amazon continue to dominate the cloud infrastructure. Alphabet coming on with their AI first strategy, showing some signs there. Apple delivered record results through hardware services strength. I mean, it's just this quarter was monstrous. The big guys are getting richer, as we said. So, I mean, quarterly revenue, Microsoft 76 billion, Apple 94 billion, Alphabet 84, Amazon 153. Great numbers. Microsoft Cloud, that was a big story. I loved your tweet storm you did this morning on this. You also did a breaking analysis, kind of an emergency breaking analysis on this. Their cloud revenue, 46 billion. Okay. roughly? I mean, is that the number or is it lower? I mean, I'm seeing
You're
Amazon
talking about Microsoft?
yeah,
You're talking about
Amazon's at
Microsoft. So,
25 billion.
so
What, I mean,
so here's the thing. So,
take us through the cloud, squint us through the
so,
cloud
so,
games here.
so Google, I think all three hyperscalers had great quarters. Amazon got crushed today. Did you see the stock today was down, gone 8% on an outstanding quarter? And I think it was down for two reasons. One is three reasons, maybe the CapEx was like 30 billion and they said, we're going to keep spending. I think the second reason is they were conservative in the guidance, which, they always are. So you got to take that with a grain of salt. But where I think the street got it wrong, John, is the big narrative in the Wall Street Journal today was Amazon growing at 17.5%, just slightly beat expectations, but it's significantly lower than the 39% in constant currency that Microsoft Azure grew, and it's lower than GCP. GCP doesn't report, but I've got them at 40%. They grew in the mid 30s for their overall cloud, but GCP grew significantly faster. So you've got Amazon at 17.5% growth. You've got Microsoft Azure at 39% growth, and I've got GCP at 40% growth. So everybody's like, oh, Amazon's got a real problem. Here's the kicker. If you go back to when Amazon Web Services was the same size as GCP, Amazon was growing at like 45%. Okay, so way faster or significantly faster than Google's growing. Now, Microsoft, they are so clever. They are playing a shell game. What Microsoft did last fall, they recast their definition of Azure. So what they did is they took out certain sectors like certain enterprise security and end user licenses for Power BI and some other low growth or negative growth items, took them out. They were rather large, but they took them out of Azure. What that did is it lowered the actual Azure number, which, by the way, they never reported. They never gave an Azure number, but so that effectively lowered the number. But it also, and then they put in Azure AI services, aka ChatGPT inference, which at the time was relatively small, maybe $1 billion. But it's growing very fast. So but they reported their growth rates for Azure. This is kind of nuanced. And so their growth rates looked great. Wow, look at how fast Azure's growing. They just changed the definition of Azure. Okay. Yeah. Now, fast forward to last quarter, which was their fiscal year end. They announced for the first time ever, notwithstanding the leak documents, which was included the old definition from the Activision trial, but for the first time ever, Microsoft announced Azure numbers, and they said we're 75 billion. I actually had them at 73 and change, so it was pretty close. But here's the thing. About 3 or 3.5 billion of that was AI inference from OpenAI. So if you back out that AI inference from OpenAI, it's about 20% growth. If you go back, and so it was about 19 billion. If you go back to when AWS was just 19 billion, okay, we got to go back to 2022. AWS was growing at that time at about 33 to 35%, compared to if you take out the ChatGPT, Microsoft Azure growing at 20%. The point is, Microsoft is playing the shell game. They don't want you to know that they've got a ChatGPT tiger by the tail, and that's driving a big chunk of their revenue because 50% of OpenAI's revenue goes to COGS, which goes straight to Azure. So that is a sort of a false positive on Azure growth. And by the way, as you get to GPT-5, it's going to be way more compute intensive. You could see Azure growth at 40% or higher, sustained. But again, it's somewhat misleading because it's got that GPT tiger by the tail. A nuanced, but nobody's talking about this. And so we wanted to share that.
Yeah, Microsoft's got the classic CFO. What's your revenues? Whatever we say it is.
Yeah.
Attitude. And so, this is a shell game. I like that word, but Microsoft is playing the street, basically. They're basically calling whatever they want to call it.
Absolutely brilliantly. And they crushed the quarter because they have such great software estate. Like you said, they can show profits and they can show cash flow, till the cows come home.
What is Azure? Whatever we say it is. That's their strategy. And I think that you're right about the OpenAI. I didn't have those numbers, but that makes sense. Now OpenAI is trying to distance themselves a little bit with Microsoft. There seems to be a negotiation there somehow, from what I'm hearing. But we'll see. I mean, again, Microsoft is kicking ass.
I got to
and we'll
give
see what
George
they do.
Gilbert credit for that. Now I updated. We wrote a post, like you said. We did a special breaking analysis. Microsoft earnings turns up the heat with Azure AI and the data center arms race. I put a chart in there of Microsoft's Azure's calendar year quarterly revenue estimates, and you can see right around the time, so it's growing like this, and then right around the time they changed the definition, the revenue estimates flatten. Now these are my estimates, but they're, like I said, I was within a couple $1 billion of the 75 billion, and in this past quarter, it shows, this past year, just this straight line up, which is the OpenAI inference boost. So take a look at that chart on SiliconANGLE, and it was good. It was good reconnaissance by George, and then I tied it into my models and connected the dots. And I think it's really important because Jassy made the point that, well, look, we're larger than these other firms, and if you look at the numbers, Amazon Web Services will be 126, 127 billion this year. I think Azure is going to be 87, 88. So they're starting to get closer. Jassy's making the argument of the law of large numbers. Now, he probably doesn't want to dig into the Microsoft shell game, the subterfuge. I do, of course. And so, but I think it's a more plausible explanation as to really what's going on here.
All right. Well, we're going to watch the earnings. Of course, we're watching like a hawk now. Certainly, we're here in the building of the exchange. We'll be watching the stock. The option market was on fire today with the whole tariffs and the jobs report. So we're seeing a lot of red numbers today here on Wall Street. You brought up the Palo Alto CyberArk acquisition. Okay, M&A's hot, funding's hot. I mean,
I love that deal. I absolutely love that deal. It's like $2 billion in cash, and the rest is in stock. And it takes, look at Nikesh Arora. I mean, he's got a $10 billion, little less, $10 billion revenue company with a $115 billion market cap. He's got to expand his TAM. He's going hard. They are unambiguous about their platformization strategy, and they're going hard after, industry consolidation. And this expands their TAM by at least 20 billion, getting into identity, maybe more, maybe even 30 billion. I absolutely love this deal. It's a couple billion in cash, and the rest is all stock. So they're using their appreciated stock to buy a quality company and a quality install base. And they're really good at acquisitions, and it's accretive from a gross margin standpoint. It's accretive from revenue growth standpoint. It is not free cash flow accretive until fiscal year 2028. That is a negative, but I think it's a no-brainer for them.
Well, if their strategy is to get best of breed into a platform, that's a good move for them. Again, TAM expansion, but the free cash flow, they're banking it on the back end. And like you said, the incentive is the stock appreciation. So nice alignment there. So everything tees up for Palo Alto, right? So
and CyberArk. I mean, my friend Tom LaHive works for CyberArk. I'm stoked for him.
Good for him. Yeah, get him on the cube once this thing settles in. I mentioned the IPOs. Ambic went public the day before Figma, so the IPO market's open. We kind of talked about that. The funding market. Let's talk about the big numbers. Besides the war on talent, where there's billion-dollar job offers being tossed around now. OpenAI is reportedly in talks to raise $8.3 billion at a stunning $300 billion valuation.
Yeah, well, they better to fund those models.
Anthropic is in talks to raise $5 billion and $170 billion valuation. Vast Data is looking at a multi-billion-dollar funding round at a $30 billion valuation, and there's a load of $100 million fundings going on. The Series Bs tend to be around 100+ million raised, 1 to 300 million. When I did a venture-backed startup over 20 years ago, and a Series A was 5 million. Series B was like 15, 30 if you were good. Now Series A is 50 plus. The Series B is 100 to 300, and you're a dog if you're doing it at 100. And obviously you're starting to see the late stage. So it's going to be a very interesting pre-seed market right now, and a lot of people are scratching their heads, squinting through the noise, trying to find the signal. So we'll see what happens. I mean, this is an unbelievable capital market on the private side. The private side, as we cover the startups from inception through IPO, we've never seen this kind of late stage action. So the question is the demand going to be there? Will the enterprise market open up? You look at the hyperscaler markets where most of the big revenue's coming from, companies like Lambda, these neo clouds, CoreWeaves, DDN, Vast Data, mentioned it earlier. There's like 7 customers. They already got them. So like, what do you do next? Right? You got to get the enterprise. So I think the enterprise will be a very strategic market. We have to watch that very closely, Dave. So this is something I want to get your thoughts on because, I have my opinions. I'm seeing not stall, but like like we're waiting for the doors to open to the subway. Can I get on the train? Let's go. So like, what's going on? It's sitting there waiting to be disrupted and enabled with AI. So, the disruptive enablement of AI is certainly hyped up. Is the enterprise ready? Can they do it? What's your take?
No,
They're
they're not ready. They're definitely not ready. I mean, look at like I said before, all the action is in this CapEx. There's still a lot of experimentation. I just think the vendor hype that we hear about, we've exited the experimentation phase and we're entering the scale phase is absolutely not true. I think when you talk to boards and you talk to CEOs of enterprises, not tech companies, they'll tell you, yeah, we're learning. We're just kind of scratching the surface. To your point, RAG-based chatbots, they're nice, but, really not moving the needle. And of course, the headlines in these tech companies are how, they're not hiring, they're laying off people, they're replacing people with AI. There is some evidence that we're not seeing as many entry-level people. But I don't really think it's moving the needle in a huge way yet. So I don't think the enterprise is ready. And the big reason why we talked about before, it's the data.
Yeah. All right, Dave, I know you got a hard stop at 5:10, but just want to get your thoughts.
I'm going to F1 tonight.
You are?
Going to the movies. Yes.
Oh, I was going to say, cool. I heard that's really good on the big screen. Got to see it on the big screen. Don't wait for it on home Netflix or Apple. I think it's on Apple, right? So yeah. Let me know how it is. I haven't seen it yet. I'm gonna have dinner with my daughter here in New York and
awesome.
Work the weekend. And as we continue to build out the CUBE studio the next month, we're getting new equipment. We're gonna get locked into Palo Alto and to Boston.
You coming to Boston next week? Am I gonna see you, or am I gonna go down there?
I'm gonna try to shake the schedule down. I got some deliveries, but got the new equipment coming in. This guy that I got to build the desk for the anchor desk, turns out I sent him some mock-ups at ESP. I actually worked at one of the studios in New York on fabricating the set. So ironically, on Thumbtack, which is like a TaskRabbit service, this dude's awesome. So we'll see. Just overall action here is just fast paced, as you know. You were here, so there's demand for the studio. We're going to ramp it up, keep it going, and just turn it on as fast as we can. I was obviously the stock exchange quiet right now. It's the end of the day, but yeah, during the day, it's a machine. I mean, today was very busy with the market fluctuations.
Well, I had thought I was pretty confident that August 1st was going to be a bad day, which it was. We've shifted now into the dog days of summer, and just a whole sentiment change. It was about time. I mean, this market refused to go down. I mean, it's been what an insane July.
Yeah, I mean, I gotta say, with the earnings results, I was actually not shocked, but I didn't think they would be across the board that positive. And with the Figma IPO, the thirst for tech IPOs, that's very bubblicious, in terms of the market. So, let's see if the fundamentals of these companies, again, who are the real deal, who's got the real deal. And like I said, Figma, is a Netscape moment. Remember, Netscape didn't last very long. Microsoft crushed them. So, if I was Mamoon and if I was John Lilly, I'd be like, guys, you don't want to be the Netscape of the market. You don't want to be the darling and then, fall off favor by not executing. So, Figma did get a nice pop, but to me, the story here is it's over now. It's like celebrating when you win the conference championship and now it's the Super Bowl time. You got to go back to the game and start all over again. Have your party. And if Figma gets back down to business, then we'll see. That's what they do. It's going to be interesting to see what they do. The young company can hit the shot clock.
OpenAI, are they Netscape or Google? We'll
I think they survive. I mean, this is a tough call, but I I love OpenAI. I got to tell you, I love Anthropic. I think Amazon continue to put their hooks into Anthropic, gives them an edge. I think the sleeper in all this is AWS. You know, I mean, you got to call me a fanboy, but you know, they're taking a lot of heat. We'll see. We debated the product strategy this quarter, but you know, I don't think they're getting rewarded. And to your point about the acquisition with CyberArk with Palo Alto, that is the trend. That's not just a one-off. I mean, Palo Alto's engineers are smart. Zug was on the Cube. He pointed it out. We got to completely re-platformize. So you know,
I agree with you. I only call you a fanboy when you say Amazon's going to put Microsoft out of business.
That was 4 years ago. I was wrong. I was wrong on that one. But they are kind of putting them out because
you're right a lot. Wait, go ahead.
They're fudging the numbers, Dave. I mean, come on, you said it.
I know,
yourself.
but they've got such a software estate they can afford to do that.
Look, if you're a hyperscaler, you just got to fall out of the boat to hit the water. That's how good the market is for them.
Yeah.
I mean, Oracle's going to be in there. You're going to have Google. And I think the game will be fought on user experience. And I think Google's got a shot. And Amazon, the only thing that Amazon, I think, could be an Achilles heel for them is that their old school way to interact with the cloud could be disrupted by someone who makes it better. And that's why at AWS Summit in New York 2 weeks ago, I asked Matt, who runs Marketplace, and Chris Gruge, does the Marketplace become the new console? Because with agents, you can actually abstract away the console. They kind of had a smiley grin, wait for reInvent. That was kind of the phrase. So that was not a yes, but that means that if I'm going to be purchasing through the markets, why can't I build product there with all these agents? So why can't I do all that? But again, I think Amazon is going to be a winner in the end game because like CyberArk is going to be a back-end loaded deal for Palo Alto. I think the AI wave will be a back-end loaded opportunity for Amazon. I think they're in retooling mode at massive scale. You pointed out some of the growth numbers a few years ago, and still, even though at 18, 17%, whatever the number was, you said?
17 and a half.
It's still massive growth. So,
I agree.
How do you transform at that level?
Again,
I mean,
when you go back in time and look at the size of Amazon, back when, when they were the same size as my revised Azure numbers and Google, Amazon was growing just as fast, or actually several points faster. So Jesse's point is right, but the street's not buying it. And I do actually think, and he said on the call, they're still supply constrained. They still can't meet demand. I love that. So I agree with your analysis on that.
Yeah, every company is transforming. That is the number one thing in the market right now. That is absolutely clear. Every company. The question is, the bigger you are, the harder it is. The smaller you are, the easier it is. The mid-range ones, the mid-market, market cap companies, they're going to be in an innovator's dilemma. Do they go all in and put more money into that effort? It's like maybe it doesn't pay out. There's a lot of risk mitigation going on around that piece. So huge issues to unpack. We'll do it on the next time, of course, this week. Dave, we're going to continue to build out the studio. We'll see you next time.
All right, John. Thank you. Thanks, everybody.